Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We've been monitoring some news when it comes to TikTok.
Yeah, well, speaking of President Trump, he signed an executive order to extend the deadline for TikTok's Chinese parent ByteDance to divest the platform's U.S. operations until December 16th. So another extension. Also some details about U.S. operations, including Oracle, Silver Lake, and Andreessen Horowitz. Oracle would keep the TikTok cloud contract. This would be the group that would control the U.S. operations of TikTok. For more, I want to bring in Brad Stone. He's the editor of Bloomberg Businessweek and the author of Amazon Unbound, Jeff Bezos, and the Invention of a Global Empire, among many other books. He joins us from our San Francisco bureau. Brad, the latest on TikTok, it's interesting because it's one that's sort of faded into the background a little bit until it comes up for deadline, and then also comes up as sort of like a tool for trade negotiations. I'm just curious what you think of this group, Oracle, Silver Lake, and Andreessen Horowitz, and the idea that U.S. operations would be controlled by a group that, you know, you've come to know pretty well in Silicon Valley.
Right. Well, first of all, Tim, how long have we been talking about TikTok?
I can tell you, I can answer that question for you. It was during the first, longer than I've been at Bloomberg. It was during the first Trump administration that we were talking about this. I feel like
we'll be in the retirement home one day analyzing this. Look, I mean, first of all, you know, they're talking about spinning off the U.S. operation into this consortium of Oracle and Andreessen Horowitz. They're talking about asking TikTok's 170 million U.S. users to download a new app. So that's a little bit of friction right there. I mean, frankly, this to me seems like it would be a win for Meta and YouTube. Yes. I mean, there's very little that says this new TikTok U.S. operation that licenses the technology from ByteDance, but then recreates the algorithm domestically. It just doesn't sound like an agile company that can adapt to the rapid changes we're seeing in social media and AI. And I just have to question, you know, because we have been talking about it for so long, whether the spinoff will really happen. You know, this has been promised and or threatened many times over the years.
And, you know, Brad, I'm also seeing some reporting out, I think, from the Journal that said U.S. investors holding a roughly 80% stake and Chinese shareholders owning the rest, according to those in the know. So, like, and I think there's going to be a board and there's going to be one board member designated by the U.S. government. It just, as you say, it just sounds like kind of a strange entity.
And tiptoeing around the law, right? Because during the Biden administration, you know, Congress passed a law that said that the TikTok algorithm would have to be created and controlled in the U.S. And yet, you know, according to this report, they'll still be licensing some technology from ByteDance. So, of course, the devil will be in the details. And, you know, you can also imagine that it's all subject to the next presidential pronouncement and a potential trade deal with China. And so we'll see. We'll see. But look, I mean, this is terrain that, as we know, in Silicon Valley, everything changes every single day. And the idea of asking 170 million users to download a new app with a new algorithm and then to compete with the likes of YouTube and Instagram that really over the past few years have copied a lot of TikTok's functionality.
Not doing it. I'm apped out already. Brad, what I want to ask you about, I'd much rather look at some AI slop. Can you talk about AI slop? I do have to say,
I just have to say, people give AI slop a hard time. Carol Massar, Brad, is a fan of this stuff.
Talking
she's like
babies,
reading the story earlier
animals.
Today, and she's saying, I love this stuff.
I've lost many moments of my time watching stuff. Tell us what it is, though.
Right. Well, so this was my opening essay for our October issue. It's our screen time issue. And I'm looking at, and if you use social media, you're probably familiar with it, the AI-generated video that has come to Instagram and TikTok and YouTube. So talking dogs with their own podcast, babies being interviewed, bunnies jumping on trampolines, all sorts of craziness that is in our feeds right now. It really has been ushered in just over the past few months, in large part, Google introducing a new tool, VO3, which, as you can see here, does a pretty good job, not just with video generation, but also audio generation, transferring a written script that the user inputs into spoken dialogue and also a sort of realistic depiction of it.
I got to tell you, I'm watching those dogs. Sorry for those who are listening on radio, but those dogs, man, I believe it.
You think they're really talking?
Yeah, I believe that they have a podcast.
What is the matter with my dog that he's not podcasting? I don't understand.
Yeah, here.
We need more podcasts. Come on.
Are people making a lot of money off of this?
I've talked to a bunch of creators, and all of them alarmingly young. I talked to one 13-year-old who is generating videos using stormtroopers, so Disney IP. He made like a couple $1,000s over the summer just putting up these short videos of stormtrooper misadventures onto Instagram and TikTok. I talked to a set of brothers from Montreal who were supporting their pet app by producing the dog podcasting videos, and it's been a great marketing tool. So some of the social networks do pay creators for creative content. It's also a marketing tool. I don't know that anyone's getting exceedingly wealthy, but certainly the attention and the eyeballs are there.
I'm curious about what this all means for Hollywood and for content creation, and it kind of gets into this a little bit because, as you mentioned, this is the introduction for the screen time issue of Bloomberg Businessweek. And I'll use this as an opportunity to plug the event, Bloomberg Screen Time, October 8th and 9th in Hollywood. Carol and I will be there. I assume, Brad, you will be there. If there's still tickets, you can get them at BloombergLive.com. We hope to see you there. What does it mean for Hollywood? Because there have been a lot of concerns about the ability to create content that has become so realistic, and what it means for the folks who are to the south of you, Brad.
Yeah, I think it just shows how rapidly things are changing. Just a few years ago during the writers' strike, Hollywood writers expressed a real allergy to the use of AI in professional productions. And now we have this groundswell of content that's being created in dorm rooms and in basements that's flooding social media. It's pretty good. It's pretty high quality. And then we're seeing a little bit of a loosening of the restrictions in Hollywood. There was a studio that was aligned with Amazon that recently announced it would be sort of finishing or recovering some scenes from one of the last Orson Welles productions, The Magnificent Ambersons, using AI. So you sort of can sense the winds shifting a little bit in Hollywood, and a realization that the technology is getting so good it can no longer be ignored.
The one thing I keep thinking about, and you touch upon this, is the responsibility of social media companies, Brad, in this column. And we've already seen the difficulties in policing harmful posts and information, and I'm thinking deep fakes and so on and so forth take this potentially to a whole other level. So I don't know, what are we hearing when it comes to oversight and responsibility and stuff that could be harmful?
When a creator uploads a video to Instagram or TikTok, they're asked to check a box as to whether the video has been AI generated. It's essentially optional. And look, I think the potential for confusion, for deep fakes that defraud, deceive viewers is so high that it probably is incumbent upon the companies to label those and to use technology, employ technology to look for hidden fingerprints or other indications of AI, and to do their viewers a service and show when AI is being employed. I use the example, and maybe some listeners remember this, of the bunnies jumping on a trampoline. A lot of people thought that was real. It was AI generated. It was a video that was popular over the summer. The creator of that video didn't even realize he was being asked to mark the video as AI generated. So the companies probably need to do a little better job telling people what's AI and what's not.
Hey, Brad, real quick. Apologies to end on a somber note here, but I've been meaning to ask you about this, and we have the opportunity now. Last week, Governor Spencer Cox of Utah gave a press conference following the assassination of Charlie Kirk. And he said something that stuck with me. He said, social media is a cancer. And it made headlines, but it made me question, is this going to be a moment where social media companies take a look at their algorithms, or is this just a speed bump or something that isn't even considered when thinking about algorithms?
I mean, Tim, there's no evidence of it. Particularly over the last year, they have downshifted content moderation strategies, partly under pressure from the U.S. administration. And then you look at services like X over the last week, and everyone is almost their worst selves, right? And going to battle over what's really undeniably a tragedy. So, no, there's no sense that that companies are amplifying or amping up their content moderation strategies. In fact, they might see it as a political danger, and so are doing the opposite.
Yeah, it's kind of remarkable, this environment. Brad, we got to run. Thank you so much. Looking forward to talking to you more, and looking forward to being there with you on Screen Time. That, of course, is our Brad Stone, editor of Bloomberg Businessweek. He's the author of Amazon Unbound, Jeff Bezos and the Invention of a Global Empire, many, many other books, too. So I highly recommend all that he has written on.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get to, Tim, a trusted voice when it comes to the U.S. Treasury trade and what the Fed is up to.
Katy Kaminsky is Chief Research Strategist and Portfolio Manager with AlphaSimplex Group. She joins us from Boston. Also the co-author of the book Trend Following with Managed Features, The Search for Crisis Alpha. Katy, good to have you with us this afternoon. First, make the call about the Fed's, not just tomorrow's move, but also the move to the end of the year. We want to put you on the spot here. What do you think happens tomorrow? And then what do you think happens for the remainder of the year when it comes to the path of policy?
Oh, you love to do that. I get that. So I'd say 25 tomorrow, but that's consensus. But I do think we will get some more cuts later this year. And the market has definitely already been pricing that in, particularly in the futures market. What that means is that people are expecting this to be a catalyst, a start of a new regime, which is important.
Well, having said that, I was thinking about your background. You've got a Bachelor of Science in Electrical Engineering, a PhD in Operations Research from MIT. Yeah, you're super smart. We know. I'm just wondering, Katy, is it easier to kind of figure out Fed policy, the U.S. fixed income market right now, or is it easier figuring out a complicated electronic schematic? I'm just curious with all that's coming at investors.
I actually think it's equally as complex. And let me tell you why. Is right now is a very interesting time in history for looking at the Fed, and just the amount of dissent is actually is unprecedented. So we haven't seen 3 dissents since 1988, and you're starting to see a much wider range of views on the Fed itself. So I'd like to say that this is going to cause a much wider reaction, a range of reaction, or more volatility in the reaction function of markets once those decisions come out and we try to figure out what that means.
Is that dissent, in your view, political, or is it representative of a lot of things coming out investors and maybe some mixed signals?
Well, I think, there's clearly some political leaning in terms of that type of dissent. I mean, but just the fact that you have such wide range of opinions. And I think, like I said, we haven't seen this many dissents in Fed votes for decades. So it kind of suggests a new regime shift, a very different type of Fed to try to analyze. And everyone's trying to understand, are these dissents going to move to a new consensus, or are we just going to be in the same scenario for a longer period of time?
Do you think the Fed is independent right now?
I mean, I think, it's hard to have. Nothing is ever 100% independent in Washington, as you guys already noted, as you all already noted. But I think the fact that, there's definitely influence coming from those that are appointed that has a potential to make independence a little bit weaker than it was before. And that's definitely the market's sentiment on that. And the things that you see is there's a lot of concern over that. And that could put the bond market at risk.
So when you look at what are you now looking and thinking in terms of how low rates can go, Katy? I mean, we have talked with you throughout the last 3 to 6 to 9 to 12 months. And there's points where we were talking about 5% on the 10-year. We've gone below 4% on the 10-year. We're right now kind of at it. So I'm just curious, what's the smart thinking in your view when it comes to where U.S. rates trend?
So this is a very good point. We have seen more long pressure in bonds. We're starting to see trajectory towards lower rates. What I get concerned about is if we stay in the middle and we sort of have a smooth and steady ride down in rates, I think that may be something where no balance gets tipped. On the other hand, if we have a very aggressive move downward in rates, we could have some overstimulation. We could be at risk for inflation, and we could risk losing parts of the long end of the bond curve just due to investors being concerned about rates being too low and inflation being too high. So I think for me, it's coasting in the middle will give us a nice trend down in yields.
Wait, so did you give me levels? Did you give me
Not
numbers?
exactly, but maybe 3. I don't know.
Really?
Hopefully, I don't know. Maybe 1.
Wait,
depends on the time horizon, though.
Did you say 1?
No, I definitely didn't say 1.
Okay, but maybe 3. Are you saying 3 for like the 5 year?
3.5.
3.5.
Perhaps.
All along?
I mean, the 6-month SOFR contract is already trading at a 3.4. So, we could get there. I don't know.
What about when it comes to growth? Should investors be concerned about stagflation?
Well, I mean, I think stagflation is one of those corner cases where, if things are calm and we have a balance in terms of growth is strong enough to withstand, for example, tariffs, inflation, then we should be in an okay position. I think what people really get concerned about is sort of putting the pedal to the metal, right? So you basically cut rates too quickly, try to overstimulate, it doesn't work. And then suddenly inflated prices are there anyways. And so I think there is a concern because it is really sort of a very bad economic situation. It's not just low growth, it's low growth when the power of your purchasing power has gone down. And so I think we love to talk about it because it's sort of like the Armageddon of difficult scenarios.
Hey, I just want to get a couple headlines that are crossing the Bloomberg right now. Silver Lake and Andreessen Horowitz in a TikTok investor group. This, according to the Wall Street Journal. The Wall Street Journal also reporting that TikTok's U.S. consortium would include Oracle. The TikTok deal would create a new entity, and U.S. TikTok users would be asked to shift to a new app. This is all according to the Wall Street Journal. This comes after we did learn a little earlier that the U.S. has extended the deadline to sell TikTok until December 16th. The White House issued an order earlier, just in the last hour, on TikTok, extending that TikTok enforcement delay. Hey,
Katy, before you go, what are you watching out for most? We get a dot plot tomorrow. We've got a new member on the Fed board. Stephen Myron, of course, from the Fed, not from the Fed, excuse me, nominated by the president. So I'm just curious, what's top of mind? I feel like there's going to be a lot coming at us tomorrow.
I think for me, it's the dispersion in the dot plots. Do we see a much wider range, and how do we distill that information? And also the size of the cut. Let's just be honest. Like, do we get a surprise? I mean, I think that is always an interesting scenario to think about, a 0 or a 50.
All right. Going to leave it out there. Always appreciate your time and such a timely interview at that. Katy, be well. Katy Kaminsky, she's Chief Research Strategist and Portfolio Manager at AlphaSimplex Group, joining us from Boston, Massachusetts.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hey, over the summer, one of the things that caught our attention, Bloomberg News reporting that the world's largest technology companies, so we're talking Microsoft, Amazon, Google, all of them planning to spend billions of dollars, more than $344 billion on capital expenditures, with much of it, Tim, going to data centers for AI models.
According to Bloomberg intelligence analyst Amandeep Singh, companies have, quote, basically tripled CapEx investment in cloud due to AI, with executives emphasizing the need to invest quickly to get ahead. Our next guest is helping those hyperscalers scale up when it comes to AI. With us in studio is Adaire Fox-Martin, president and CEO of Equinix, the nearly $76 billion market cap data center REIT. It trades under the ticker EQIX, down so far this year about 18%. Adaire, welcome. Good to see you.
Thank you so much. Thank you for having me.
Nice to have you.
So how's business?
Business is very good.
Like the best you've seen it?
Like we're in the middle of a very strong cyclical demand cycle for, the products and services that we offer.
When you say we're in the middle, help us understand how long that means of a runway there is to go here.
Sure. At Equinix, we see a very significant trend from the training of models in the AI economy that you refer to in your opening there with the hyperscalers, to the deployment of those models in enterprise systems. And that deployment is called inference. And we see that opportunity as potentially double the size of the training opportunity. And at our company, we feel we were built for this moment.
Has that happened faster than everybody anticipated? Because I do feel like the conversation, although we've been talking about AI now, almost 2.5 years, well into 2.5 years, but we are now increasingly talking about all of this stuff starting to be put to work.
Right. You can certainly see organizations. We have 10,000 customers across the world moving from proof of concepts into production systems and applications of the technology.
One of the things I think we're curious about is, as you know, the news flow is fast and furious from the White House and out of Washington. And there have been some announcements out of the Trump administration about AI infrastructure initiatives specifically. So I'm curious, Adaire, have you seen any impact of that on your existing properties leasing effort? And I'm curious how does that kind of compete their program with your own development program?
Look, we very much welcome the focus that the current administration has on data centers and the importance and the recognition of data centers and their important role in the infrastructure of any economy. And we certainly are looking at, some of the properties that have been, identified as potential for RFPs, and we would choose based on locations that would be accretive to our business, because we're very focused in cities, in metro areas, close to where humans are who will use this technology.
Are you getting pushback from cities and humans who don't necessarily want those data centers near them?
Not hugely. I mean, we're very conscious of the role that we play and, the role that we play with communities where we have data centers. And we're very considered about our approach there.
What makes a good location for a data center? Because it doesn't actually, apart from the construction, it doesn't actually involve that many people to keep it up and running relative to the amount of money that's spent on it and what actually happens in there.
Yeah, it's really interesting because I think, when you think about the operations of a data center, you tend in your mind to go immediately to technicians and technology. But actually, there's a whole series of unsung heroes in the operation of a data center, which are the craftsmen and the tradesmen and women, the plumbers, the electricians, the engineers, who basically keep the internet up and running, through this data center infrastructure.
So difficulties in finding those workers? We've done some reporting about that there's, yay, great, the spend and the build, but there's not enough workers to do it.
So I think, the constraints that the industry are facing are around energy and power, around skilled workforce, and then into the supply chain for the equipment that's part and parcel of a data center.
But is that slowing the build that you guys are trying to do and meet that demand?
It is something that you have to actively manage as you are looking to build. For example, in our case, around some of our supply chain portfolio, we've pre-purchased in order to ensure that we can have the delivery dates that we need to bring capacity online.
We talked about the $344 billion that some of the world's largest tech companies are planning to spend when it comes to CapEx. It's like the thing we look for now quarterly when a company reports results. How much of hyperscalers' CapEx budgets actually flow through your company?
We have a very significant approach on a part of the data center industry that we call co-location, because not all data centers are the same. And so co-location is where enterprise customers, businesses, 60% of the Fortune 500, for instance, would locate their workloads or their machinery with us and in a shared facility. We have a JV structure that works with the hyperscalers to build to suit for the hyperscalers. And so that's how we service the hyperscaler opportunity and maintain that very important partnership that we have with them.
I guess we're trying to figure out your exposure. I think your top 10 customers represent about 16% of monthly recurring revenue. So your exposure to the hyperscalers is pretty big, right? Is it manageable? It's
manageable. You know, the hyperscalers, for example, when they operate in our retail facilities, they do so because of the connectivity of Equinix. So that's going to be a requirement, you know, for inferencing and for the actual activation of these AI workloads. So it is for us about connectivity. Connectivity is the secret sauce of Equinix as a data center provider. What do you mean specifically by that? Because I think we can use the word connectivity to mean a lot of different things, certainly in the business world. What does it mean specifically? For us. Yeah. So in our world, it essentially means we're located in 273 data centers right across the planet. Inside those data centers, we have ecosystems of customers, customers whose value chains are connected to each other, and we physically connect them, you know, literally interconnect those customers one to the other. That's the first part of interconnection. So that allows for low latency transactions to happen. Say, for example, on a trading floor, that allows for that to happen in real time. Right. Got it.
We're speaking right now with Adaire Fox-Martin, President and CEO of Equinix, joining us here in the Bloomberg Businessweek studio. You mentioned the difference between training and inference. Thank you. When you think about this, like a company like CoreWeave, for example, where does that fit into this?
Well, CoreWeave is a neo cloud. They're a company that provides GPU capability to companies who want to train their models. So they fit into the ecosystem in the same way for us as other cloud
like a GPU as a service.
Correct.
Okay, so what are the average lease terms for an agreement with a GPU as a service organization?
It would depend. They can be relatively short. For us, our leasing in our wholesale side is 10 years plus.
Okay.
Now, one of the things that I think is interesting is I think we're all trying to figure out the boom and bust of all of this. And today on Bloomberg, there was an investor, Jack Selby. He is AZ VC founder and managing partner. He's longtime managing director of billionaire entrepreneurs Peter Thiel's family office. And he said the euphoria around AI may have led to the biggest bubble yet in private technology investing. And so sounding warning bells that a correction in startup valuations is in the cards. Now, we understand when you throw AI, there's a lot of different players. But behind it all is the data center spend. And we have had a lot of conversations about the hyperscalers making, multiple duplicate arrangements with power providers that they're not going to use all of them, but they just want to make sure they've got the power where they need it. Is there any signs to you that there's exuberance, that the spend is slowing down, will start to slow down maybe next year? You're seeing it. You've got a front row seat.
Yeah. I guess we believe in the enduring nature of the transformation that AI and the technology associated with it can bring to businesses. I mean, as I said, we support manifold workloads of our customers, not just AI workloads, but, standard business process workloads. And we really are about that being that connectivity engine. So, I think in many ways, our business model is somewhat protected from any potential.
Before we let you go, as I mentioned, some headlines on TikTok crossing from the Wall Street Journal. The deal would create a new U.S. entity. Oracle, Andreessen Horowitz, Silver Lake. Are you involved in this at all?
Well, we partner very closely with Oracle, so it would be through that partnership that we would be supporting.
So you think you will support an independent TikTok?
Potentially.
Okay.
With Oracle.
With Oracle.
Yes, a very key partner.
One last question. Your stock's down. Why? If it's so, I know there's also an incredible spend in what you are doing. You've got to spend in order to meet the demand. And so maybe that is why there isn't some reward from some of your investors. Yeah. Is it kind of a conflict?
We're very focused on long-term value creation for our shareholders. And, we announced that we are going to bring on as much capacity in the next 5 years as we have done in the previous 27 years of our operations. And so we're very focused on executing against our strategy. We believe in the opportunity that we see in the market and hope to deliver proof points to that to our investor community very soon.
We have to leave it there. We apologize. There's been a lot going on today, so we hope you will come back and give us updates.
Thank you very much for having me.
We appreciate it. Adaire Fox-Martin, President and CEO of Equinix, joining us right here in studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Wall Street traders gearing up for the Fed decision, refraining from making big bets as they await clues on the path of rates that will shape the outlook for markets over the next few months. On the outlook, back with us is Alli McCartney, Managing Director, Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. It manages just over $1 billion. Alli joins us here in the Bloomberg Interactive Brokers studio. I want to get to your outlook,
yes,
everything that you're watching. But when you walked into our studio, you made the point that today's the anniversary, or yesterday, depending on how you look at it, of the great financial crisis. And you were there. You were part of it.
It was. I was on a over-the-counter equity and hedge fund derivative desk. So it was...
At Lehman?
At Lehman. Yeah, sorry. I should have said that. I sort of thought that was implied. It was a crazy, crazy time. And it's interesting because a lot of the conversations now are we in a bubble? What do we do when the market is at, depending on what you look at, the S&P right now is trading at 22.3 times forward earnings. If you take out the Mag 7, the broad-based 493 is at 20.2 times. So people are anxious, right? I think the big difference we have right now has a lot to do with the Fed. There have been 4 other times in history since 1950 that markets have been this highly valued. And in 2 of those cases, the markets have outperformed over the next 12 months. And in 2 of those cases, the markets have corrected. And the difference is very, very clear. The markets have outperformed in decreasing Fed interest rate environments where earnings are growing or stable. They have tanked when the Fed is tightening and earnings are slowing. So I think we have a little bit of a recipe for, we still think the bull market continues, but you have to be cautious. We have to look at volatility. And tomorrow's going to be really meaningful in terms of the summary of economic projections, the dot plot, the descents, as your former guest said, and just in general, the tone.
How much juice do you think the economy really, really needs right now? Because, we got a read on retail sales and consumers are still spending. And I know it feels like there's a mixed bunch of data points, Alli. So how much do you think that the Fed needs to do?
There are a lot
Not
of
just for tomorrow.
Yeah, it's the right question. What does this whole tightening cycle and what does the neutral rate look like? So the question is, back to what we were talking about initially, is this insurance? Or is this against a growth scare? The numbers that we have seen have been very mixed. The effect on consumers in terms of tariffs, in terms of dwindling savings, in terms of high interest rates, have not really appeared to create issues yet. I don't think it derails a bull market, a Fed tightening cycle, and increasing earnings really as a tailwind with AI and increased efficiency. But it's not going to be easy, right? We increasingly have a world that is the haves and the have-nots, and the have-nots are in a really, really tough place. And so I think that some of these interest rate cuts are going to be stimulating the housing market, stimulating Main Street, allowing people to borrow, and making economic opportunity more uniform. But I think go ahead.
Well, yes, because Tim and I talk about so much, like with Peter Atwater over at William & Mary, of the K-shaped economy, right?
Yeah.
The haves and the have-nots. And I get it. I get why rate cuts will help folks that are having a tougher time right now.
Yeah.
But can we do that without those folks who are doing just fine, not leveraging up and doing crazy things?
We're going to see the answer is probably not, right? And think back to the times in the economy where we have had very low interest rates, and ultimately what has happened, because what does it do? When you lower interest rates, you push people into risk assets. So what I'm looking to see tomorrow is exactly that. Are we getting a dovish Fed, right? Are they saying this is the beginning of 3 to 5 more cuts over the next 12 months, in which case I think markets and risk takers will go all in? Or are we getting a hawkish cut, which is sort of the standard Powell response, which is we're still going to be data dependent. We still know there's a lot of risks out there, but I'm looking at the labor market.
I just can't imagine Fed Chair Powell making a commitment that far in advance, somebody who has made such a point of emphasizing how data dependent he is and how data dependent the Fed is. I can't imagine it's going to be the former. I think it's going to be the latter.
Agreed. But that's why I think the concept of dissent and understanding who the dots on the dot plots are, because remember, his dot's going away very soon. The other dots and the ones that are going to be the future dots are probably going to be much more politically and partisan aligned. So I think that's really what one needs to focus on in terms of deciding if we're going further north or if it's time to sell and take your gains.
Does that concern you, though, if the dots are politically aligned
Hugely.
rather than aligned
Hugely.
with what these individuals think or what economists think the rate should be?
It personally and professionally, it concerns me a lot. I think a politically aligned, or said another way, a non-independent Fed is a really challenging place to be.
Does it make you think differently about deploying assets in the United States?
I think that long-term implications, yes. But I think that at this point in time, and when I say short-term, I even mean throughout this presidency, no one's going away from the dollar. They may be going more into gold, which is also dollar denominated. They're buying a little less treasuries overseas, but not much. So I think that we have 60+% of the equity capital markets of the world. The AI trend is one that is internationally recognized as a mega cap 5, as a US Silicon Valley based phenomenon, both from the current hyperscalers and from the fact that they have so much cash on hand that they're going to buy, not and build everything that's next. So does this create, or is this another warning sign, along with the deficit, along with other polarities of things that might put a chink in the U.S.'s armor? Yes. But do I think it's in the next 3 to 5 years? Probably not.
Would that have happened without this current administration?
At the end of the day, one of the things that, like, as a trained economist, I always look at is the demographics, right? So the demographics of this country are in trouble, right? We have more people retiring than ending the first workforce. That was before we stopped immigration. The birth rate's gone down. So when you look at us and you look at us relative to, let's say, India or China, it's a problem. But again, when does that catch up with us? And what is the rule of law and the rule of capital in those other places? And they are not as capital or law friendly as we are in terms of attracting monetary dollars or resources.
What is your expertise in kind of understanding some really dark moments in U.S. financial history?
Yeah.
And maybe the world looking at us like, oh my God, I can't believe like what you did, right?
Yeah.
But then understanding, because I think some would say that it feels a little dark right now in trying to understand how policies are going to impact the U.S. longer term, but showing that we can have dark, difficult moments and then rise again.
Yeah.
Like, are global investors willing to kind of look at the U.S. and say, okay, this is a moment in time? And that doesn't mean that the investment environment or the political environment or the global environment, the U.S. role in it, won't change again.
I think that this is a very shocking and emotional time for many people in and outside the U.S. I think that this is more serious than a lot of other points in time in how much we changed about our role as an ally, as the police of the world, as the financier of the world. But again, Russia can't take our place. The European Union can't take our place. India can't take our place. Africa's developing. China has issues, and their demographics are challenging as well. So I think it's one of those things where a lot of people and investors have hurt feelings. But at the end of the day, one thing I tell my clients is, regardless of how you feel about the policies and politics of this country, You need to lean into that greed and then decide what to do with your spoils to make the change you want to make. I think that's how other countries look at it.
You have to be quick, 10 seconds. But if we don't have an independent Fed, it changes?
I think it changes because I think that, especially let's go back to the financial crisis, you need independence and balance to get yourself out of tough situations and have discipline.
Alli McCartney, thank you. Managing Director, Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. This is Bloomberg Businessweek Daily.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.